This is Creator Finance, the only financial planning podcast built for creators by a creator. Here's what most financial advisors will tell you. Get a proper job with a steady income. Here's what I'll tell you. Being a creator or digital entrepreneur could make you wealthier than any 9 to 5, if you know what you're doing with your money. My name's George Agan, I'm a creator and chartered financial planner, and this is where creative freedom meets financial freedom. Hey, and welcome back to Creator Finance. So I have one note here, having listened to my last episode of Creator Finance, which is bring a bit more energy to the table, because I listened back and the only way I could describe it was major Eeyore energy from my last overview on Creator Finance. So this episode, we're going to dive into the digital entrepreneur wealth blueprint. And I just want to I thought on this particular episode, I would just riff a little bit in relation to what I've seen and the work that I do with entrepreneurs. I do have some clients who are just kind of out and out creators, as in they have really substantial followings through social media channels. And I wanted to just go through the questions they're asking me, the overall blueprint that, by the way, you can download as part of a Creator Wealth Blueprint, link in the description. And that basically just goes through the steps that are predictable, that I see time after time. Now, does that mean that you have to go through each one of the steps? Absolutely not. This is unique. And one of the latest topics I'm going to talk about is how important it is for you to have a theory of wealth. What does wealth really mean to you? But it's really helpful, I think, sometimes just to hear the steps, whether you walk them all or whether you stop halfway, so that you can build a life that is truly yours and is the whole point of doing this in the first place. Let's be honest, if you're a digital entrepreneur, you did not set up your business so that you could have the same structure as a 9 to 5. And I want to talk about the financial planning and tax elements that you need to be aware of. It's going to be high level. There are individual episodes that I could dedicate alone, and I will do going forward, to some of these topics. So let's dive right in. If you don't know the structure of these episodes, I do 3 main bits. The first is markets. I want to kind of give you an update on what's going on in the markets so that you can be that person that people don't want to sit next to, and so that you too can alienate people with your finance knowledge. So I want to give you a bit of an update on markets, then we'll go into the Creator Wealth Blueprint. There's a time code below, and then the final bit, I want to go in why it's so important for entrepreneurs to have a theory of wealth. So what happened in the markets this week?
My question is, how do you time the big market moves so well?
We haven't the faintest idea what the stock market is going to do or timed anything.
Well, UK inflation ticked up to about 3.4% in December. In the last episode, I explained that UK inflation, I think, is here to stay in a sticky way. We have severe pressure in relation to energy costs, in relation to people asking for more money, understandably, because inflation has been so strong recently. And the Bank of England target is 2%. So if the Bank of England is consistently above this is an issue from their side from a policy standpoint, and they actually have to write a letter to the Chancellor. And if 2009 to 2020 was the era of free money and lower interest rates, we, in my review, are in the era of sticky inflation and stagnant growth. There was also a lot happened with our favourite orange man, Mr. President Trump. He implied tariffs against European countries, saying that he was going to potentially take control of Greenland. He then backed out of it later in the week. That caused some short-term volatility. All of that stuff, in my personal opinion, is complete noise and is irrelevant for what I think most of you listening will be or watching, which is long-term, multi-decade investors. The movements of what Trump is going to do on a day in, day out are not what we should be basing multi-decade financial decisions around. But the key area of discussion for this week was actually around Japan's bonds, and bear with me on this. The 40-year yield on Japan's 7.6 trillion bond market suffered one of its most chaotic seasons in recent memory. It hit a record 4.21%. So when you hear people talk about bond yields, what do they mean? Well, when bonds are issued, they are issued with a coupon, basically an interest rate. And this is on the primary market, so it's being issued typically from the government. Now, the majority of bond trading is on the secondary market. So basically, this is investors, institutional, pension funds, even private investors buying and selling bonds from governments for various reasons. Sometimes risk management. Sometimes in the UK, we have requirements for certain security of assets. So why does this matter? that Japan's yield has hit 4.21 on the 40. Well, basically because Japan has had very low interest rates for a very long time. They also have an exaggerated overall economic situation, which some have argued ours is on the same trajectory for, which is an aging population and growth that they just cannot seem to start in the economy. They've been since now, Japan does have some things that is very unique. It had an enormous inflation in its stock market in the end of the 80s and start of the early 90s. That then severely crashed and has barely recovered since. So why should you care that Japan's debt now is more expensive? Well, in the UK, we've seen that when our debt interest costs rise, it has a big impact on the flexibility the government can have. Because ultimately, if you're spending a certain amount of the taxes you bring in purely to service the debt, that is similar to a household. That is a problem. Now, Japan's market is particularly big. It's not the biggest in the world, but it is particularly big. So when yields rise, that becomes an issue. Now, there were political reasons, which I won't go into, why this happened in Japan around Prime Minister Tachi's pledge to suspend 8% consumption tax on food for a couple of years. I'm not going to sit here and pretend that I'm an expert on Japan's domestic policy. I am not. But what I can say is this is, in a nutshell, is a significant change to the markets. There's quite a few reasons for that. There has been what's called the carry trade in Japan, where basically a lot of investors would borrow in yen because interest rates were so low, and then effectively use that to finance buying things like equity or sometimes even just getting the spread. Because if you've got interest rates that are really low for a certain government and you borrow that, and the interest rate, for example, on treasuries is 5%, there's an immediate spread there, which is one of the reasons why that's created a lot of liquidity into the market, why people have been able to use that money. But it speaks to kind of a wider, more typical issue that's happening quite a bit in governments across the world, where Japan have a real issue here, a bit of a trilemma. If it intervenes and it wants to keep yields low, which it can do, it can cap yields, it does have an issue because it risks accelerating yen depreciation further, which could fuel inflation, which gives a bit of a spiral. You know, if you're ultimately capping yields and then inflation runs away because of depreciation, then that's a real problem because it signals that you've lost faith in the currency, which can cause a host of issues. Now, if it raises rates faster to defend the currency off the back of that, so it goes, actually, we're going to defend the currency and increase our interest rates, well, that's fine, but you're going to amplify the losses on existing bondholders, which is going to exacerbate the pain that these rising yields are causing. It could do nothing, and bond yields could continue to rise, but then that could trigger a doom loop of forced selling. So it could trigger a position where investors go, actually, sack it, I don't want to hold Japanese bonds anymore. So it really does have a bit of an issue here that I think is not going to fundamentally rewrite the global system, but it's definitely worth taking note on because it speaks to the fundamental change we have had, where we've been in an era of free money, and that ended in Japan last week, and the rest of the world are going to have to take notes. Right, let's move on to the creative finance topic. So I wanted just to kind of, this creative finance topic, the main topic of this episode is around the wealth blueprint for digital entrepreneurs. And there are quite predictable steps to wealth. And considering right now, let's be honest, it's my mum and her cat watching. And the cat, actually, that's not true. My wife edits this podcast. So basically, we have a bit of a joke in our household that if I was to ever hide anything, I'd hide it in a folder called pension, because she has absolutely no interest in finance whatsoever. She's a really talented podcast producer. I think I mentioned this in an earlier episode, but she's now editing the podcast full time. So if you can imagine hell, imagine being dictated on your sleep by a mini version of me and then having to spend hours of your day working, listening to finance content. Yeah, okay. So let's dive into the Creator Wealth Blueprint. So I have built the creative finance process, the financial planning process around digital entrepreneurs and creators. And just to recap, it follows 4 steps: purpose, plan, product, partnership. So the first thing, which definitely is the main step on the blueprint, is purpose. We need to understand what is the end result of your money. What are you really doing? What compromises are you willing to take today? And what is the ideal your life you're wanting to build? Now, I know through working with individuals who are creators that can sometimes be a hell of a question. If you're in your late 20s and I'm asking you, what design your life? What exactly do you see yourself at 40? You understandably might be saying, George, I don't have a clue. And that's totally fine. What we have to do is just be directionally correct. We don't have to have all the pieces of the puzzle laid out at this moment in time. But we can use the kind of the Amazon method from Jeff Bezos, where he said, well, what is not going to change? Instead of focusing on the things that we know are, which is maybe your family might grow, maybe your health might develop, maybe something, the economy is definitely going to change. What isn't going to change? Are you someone who is still going to prioritize their health and exercising a certain amount of times a week? Are you someone who is still family centric? Are you someone who needs to be engaged to actually enjoy what they do? I think entrepreneurs really underestimate this sometimes. The goal isn't to sit on the beach. The goal is to work on your own terms and do it in things that, as much as possible, energize you. I don't like this online guru stuff where people are like, always live the dream, because here's the issue with human psychology. There is no such thing as living the dream. Life always has its little pain points, and that's not realistic. The question is, what is the structure of your life that we want to put together? What are the things you're willing to compromise on? Because this feeds directly back to how we're going to plan for your finances. Because if your financial freedom goal is, say, £4,000, £5,000 a month, then that's what we need to aim for. But there is no point in planning, sacrificing so much for the next 5 years to hit £10,000 a month if you don't need that. Because ultimately what you're doing is you're living for tomorrow at the expense of today. So purpose is key, and we need to, I think, anyone listening here should have a theory of wealth. And later in this episode, I'm going to talk about what that should mean for you, or in my opinion, what I think you should be thinking about. So once we have that, we go, okay, here are the pieces, the sort of the rocks in the jar, for want of, if you know that analogy, where you put the most important pieces in first. Now we can get quite methodical on what they look like. What's the cost? Are you moving home? Is there anything foreseeable? Are there things that are important to you? Maybe you want to, you hate the idea of student debt and you've got a daughter, so you want to make sure that they can go to university without incurring any student debt. Maybe that's important to you for whatever reason. Maybe there are certain holidays. I've got clients who go, right, we've got certain holidays. They go to theme parks and they go, that is fundamentally important to us. We have to go and do those things. Well, great. Let's make sure those rocks are in the jar. These are fundamental things that are important. And we need to, of course, understand your expenditure to do that. So once we're doing that, I would just put that into our cash flow plan, which is just basically a sophisticated tool which considers taxation, growth expectations, and ultimately allows us then to go, right, this is how much you need to get to, and this is how much you need to save today. Now, of course, because a good financial planner is then working as kind of like a personal trainer, is where if there's extra reps in the tank, it's my job to push you. So I will then not only look at what you've just told me and go, right, here's where we can make some improvements. You might have to push yourself here, but you've told me that's okay because I understand what a good life looks like to you. And these are the things you're willing to compromise, and these are the things that you aren't willing to compromise. These are the tax structures that we're going to put in place so you can hit that as soon as possible. And I'm going to come into the difference between personal wealth and business wealth in a second and how that interlinks. And then from there, it's about making sure it happens, which is the hardest bit. And this is where the partnership comes in. So now we have a sophisticated cash flow plan, which looks at products, it looks at savings rates, it looks at why we're doing this. And what I was doing with my creator client who I met this week is I was going, right, this is the number that we're going to be targeting to. And when you met with me 2 years ago, you were, they were kind of like 20% of the way there. Now we are 60% of the way there. If you continue on this trajectory for 2 years, we will have met that later life target. But here's the great news. The more I push you up, if you're happy to do that, because I'm not asking you to sacrifice entirely for today, I want to make sure you're living a good life now. But if you continue the trajectory you seem to be on, because they're just, every time I meet them, they're like, right, we've, Q4 has doubled, they're smashing it. Then what I'm going to be doing is every year, every time we meet with these plans, I'm going to be ratcheting it up so that you can basically buy yourself more financial freedom. And that's a really key way. What we're doing is we work kind of first with the later years, and then we bring the earlier years forward. And this individual, I think they're going to be financial free by in their 40s at the very, very latest at this rate. But they have to apply discipline each year, and they have to stay motivated. The idea of these plans is that they have to be multi-decade, and that I think is core to my job. It's about centering the people I work with and going, right, this is what's important to you. This is how the partnership gets delivered. I have to ask you for reasonable compromises so that your future self thanks you. But I also want to remind you that life is short, so live for today. Now, in the blueprint that I talked about earlier, link in the description, casual CTA, is the Create a Wealth Ladder. And what this basically is I put the financial products I would often consider as we go through the stages. So there's 5 stages: foundation, growth, scaling, freedom, legacy. Now, foundation is the first rung on the ladder. Very simply, this is kind of up to your first 50,000 that you're making as an entrepreneur, as a digital entrepreneur. This is, for the foundation stage, what's really important in part of the blueprint is just to make sure that the habits are right. So I need you in the foundation stage as early as you can to get at least control of your finances. I'm not saying that you're going to become a robot. I'm not suggesting that you live a crap life. I'm suggesting that we need to get control, because the phrase "what's get measured gets managed" is so true. And if it's kind of like, if you have someone professionally and they haven't built a foundation of their professional skills, they're always late. They say they're going to do things and they don't. They're just a nightmare. You can tell they're not going to progress on their career because the foundational skills aren't in place for them to then build that as leverage going forward. What we need to do with your finances is we need to get those foundational skills in place. So we need to make sure there is consistency, because going forward, we're going to need to work to some form of fixed drawings to make sure we manage tax efficiency. So we need to have at least a rough guide of what your expenditure is at the foundation stage. If you want a simple way to work this out, what's your pay? How much money do you have at the end of the month before you get paid? Really simple. If you get paid £5,000 and you have £500 consistently at the end of every month, assuming you don't have a savings investment strategy in place, then clearly your expenditure, your lifestyle costs are £4,500. Now, what we would normally do is we would then look at those figures and go, what? And I do quite like the Rami Sethis, I think it is, his rich life kind of theory, where he says, what is part of your rich life? What are the things that are, whether it's, coffees or an expensive gym membership, what are the things that give you joy? And we want to make sure that you maintain them or double down on them in some cases. But what are things that are just eking money out and are bringing no joy that we don't have to spend on? So maybe there is just some unintentional spending. Maybe we're just kind of, there's subscriptions we can cancel. There's all sorts of stuff which just isn't actually feeding your the life you want to build. So that's the foundational stage. And in the foundational stage, we want to have a control of your savings. We want to make sure we're automating when possible. So I want you, even if your first £100 is being built online, to, when possible, set up and automate savings. The reason why is not because the foundation stage is going to, and what do I mean when I say automate savings? I mean, whether it's pension funding, stocks and shares, ISAs, whether it's these key tax wrappers, or at the start, whether it's just moving money into emergency savings, so you have rainy day funds. Remember, this is someone at the foundational stage. It's not necessarily the things that you're not going to build big wealth if you only have a couple of £100 spare, but what you are going to build is habits. And that actually over time is more important than anything. It is the habits that make you wealthy. And then once you're wealthy, I have to work making sure that those habits don't get so ingrained that you don't spend. But at this stage, at the foundation stage, we need to make sure that's right and understand your theory of wealth, which I'll come back to in a second. Now, the growth stage, this is typically when you have people who are now starting to scale the business. So if the first up to 50,000, maybe you've been a sole trader for a fair amount of that. The growth stage is typically where you start flipping into a limited, and you are now building to yourself, and often with a couple of employees perhaps, or contractors. Maybe you're starting to get to 100 and 150,000. You're now at a position where your digital entrepreneurial journey has transformed into something which is now giving you similar to what is a well-paid job. That's great. That's fantastic. But we're not actually in a position where we're going to buy financial freedom any quicker than somebody in a standard career. And because of the cost of living crisis, unfortunately, a well-paid job often doesn't lead to a fantastic lifestyle at this moment in time. But what we're doing in this particular stage is we're increasing our automations, we're making sure we use tax-efficient strategies, and also we're investing in the right assets. So we're investing in growth assets if it's long-term money. We're partitioning the amounts in the right accounts. Now, between the growth and scaling stage, this is where the importance of financial clarity really comes in. So I'm not going to put arbitrary figures on here because it's different for everyone depending on the structure of your business. But as we go to scaling, I'm now thinking, right, you're kind of hitting multiple six figures. You're bringing in other people into the business. You're now in a position where tax is starting to become a real consideration if you don't manage it right. So you've got your limited now. You've hopefully got an accountant who understands your world. Maybe even you're starting to think of working with a financial planner. And it's kind of the scaling stage where, I'll be honest, the scaling and beyond are the people who I think I can have the most value for as part of the Creative Finance fixed fee financial planning service. And again, link in the description. See, I'm sneaky like that, aren't I? Anyway, at this point, financial management is so important. A bookkeeper, and I'm bringing on an interview with a bookkeeper in the upcoming weeks because this is an area I think people hire way too late. Whether it's a finance assistant or a bookkeeper, you want to stay in your circle of genius as a digital entrepreneur and a creator. You do not want to be spending all your time moving invoices around. And a great book on this is Buy Back Your Time. Forget the guy's name, but he talks about, what is your hourly rate? What is your zone of genius? And anything beyond that, once you start to scale, we need to get rid of as soon as we can. Now, let's say you've got your personal wealth. Maybe you're automating your savings into pensions and ISAs. So why pension? Watch my last episode, but ultimately it's the most tax efficient by a mile. Also, when you're building financial freedom, we have to work with the end in mind. You're not financially free if you run out of money at age 75. So it makes sense, considering the tax breaks, to do what we can to bump up your pension. The downside is you don't have access to it. So because of that, we need to now work really hard on these other areas of the business. Now, when it comes to how much of a war chest, and what I mean when I say a war chest, I mean something that is going to be there. Let's say we hit another financial crisis and orders dry up. And what is going to be there to make sure that your business survives and thrives in that environment as opposed to goes under. Now, you want to separate this into your personal and your business strategy. And when I'm working with clients, I absolutely will do this because you need a personal emergency fund. So because at the end of the day, you don't want to be taking a lot of money out of your business, which might be needed for operational expenditure, because your boiler's gone, because the roof needs fixing, because life has happened. That is a recipe for disaster, because then you get into overdrawn directors' loan accounts and all sorts of nonsense. So we do want that war chest in your personal life. It's going to probably either maintain money to inflation or lose money to inflation. We still want to use tax efficient wrappers. So if you've got a cash ISA for this, great. If you can get a good rate, great. We want to make the most of every penny we have. But the purpose of this is to give you financial stability, because you cannot make good business decisions if you're worried about money, if you're stressed. So think about this as an investment in clarity as a business owner. If you are having that extra cash, and this is what I've got to push back with clients where they're in a growth phase, and I'm like, I understand, I'm all for the growth. That's why I suggested that we go big on what I said you should use that cash instead of going to the pension for this. But we need a barbell strategy. So if you haven't heard what barbell strategy is, it's basically like a barbell. You've got weights on either side. And for a barbell strategy, which I think is especially important for entrepreneurs, you want the weight of the war chest, which is being really cautious, plus the kind of the other side, which is the risk aggressiveness, which is the investment. Because if the investment goes to pot, you want to make sure you survive. And if you ever read Psychology of Money by Morgan Housel, probably the best book on finance, he has an amazing bit on that and how it's so important and why Microsoft holds so much or held so much cash on their balance sheet. Because we need to hold two things in the challenge with entrepreneurship is you're constantly having to hold paradoxes and contradictions in your mind and acting accordingly. And what I mean by that is that you need to be risk aggressive. If you don't risk, you don't get any reward. To the same extent, things can get much worse than we could have imagined every so often. And if we're not dealing with that juxtaposition then we are risking our future and our business. So we want an emergency fund for our personal life. How much often tends to be psychological. I tend to look at 3 to 6 months of overall expenses, including rent, including mortgage and all your expenses. It depends on personal views. And this is why the purpose side is so interesting, because if you're somebody whose money story is one of scarcity, let's say money was really bad in your household when you were young, and I have kind of bits of this. My dad, when I was young, he was bankrupt, unfortunately, and that had a massive impact, and he was a proud kind of man from the Northeast, and it's something that without a doubt it has affected me. I still try and risk aggressive, but I always hold that kind of minor panic in my mind around what happens if we run out of money. And that does clearly inform my decision making in my personal life. It does impact your personal decision making. So it will do the same for you. So that will guide how much you feel you need to spare. But as a general rule, 3 to 6 months is right. Now let's think about the business. We need operational expenditure. So the great thing about digital entrepreneurs is that their general requirements for expenditure can be quite low, because it can often be subscriptions, ad costs, depending on what campaigns they're doing. Maybe you've got a couple of hires. It's not quite the huge behemoth that physical product would be as far as operational expenditure. Generally speaking, 6 to 12 months as a guide. You want to bucket this if you can hold this in separate accounts. If not, then we need to make sure that we're very stringent in relation to your company accounts. We want to make sure we're always putting aside money for tax. So we need a tax account. And then, because the way to think about tax is that money is not yours. Of course, your planner and your accountant are going to work together ideally to make sure that number is as low as legally possible. But make no mistake, that money is not yours. So we have to make sure we're getting a good interest rate when we can on it, but separating that money so it can go to lovely HMRC, because it's not worth messing with the tax man. Now, on top of that, it can be worth having also an emergency fund. The emergency fund or reserves can often get a little bit blurred. Now, this depends entirely on the trajectory and the growth needs of the business. For example, for my out-and-out kind of creator clients, where a lot of it is sponsorship driven and there's not immense, kind of reserves needed for reinvestment, then this amount can be lower. But you should still be having a conversation on what does the next couple of years look like in the business, because the bottom line is the highest ROI you are probably going to get on your money is through your business if you can use that money effectively. And that's a big if, and I'm going to come back at a later point to my experience on the more risky investments, angel investing and all the rest of it. And of course, the one thing you can't miss as far as your company is your own money. Your own money. One of the biggest mistakes entrepreneurs often make is that they don't include their own costs as part of the business expense. Now, that's dreadful for a ton of reasons. Cash flow, clearly, is the big one. But also, remember, your business isn't a job, ideally. You want to make sure that your time is factored in, because if you're not including your time, it's not real profit. I know dividends are paid after corporation tax and through profits, but your own time has to be factored in. So that's, as we go to the scaling stage, we need to be very, very mindful of how money is being allocated. And then beyond that, we need to try and start shifting money in a tax efficient way where possible into your personal name. So I touched upon pension planning in the last video as a general high level rule. And again, this is important for you to seek advice on this if you do more in-depth planning. Is the annual allowance as far as how much you can put into a pension through a limited is £60,000. You can potentially claim back or carry forward, I should say is the correct technical term, any of the last 3 unused annual allowance. So what is annual allowance? It's the amount that you can put into pensions and receive tax relief. Interestingly, I'm playing fast and loose with the word interesting there, that actually the amount you can put into a pension is unlimited, but the amount you can get tax relief on as an individual is limited to 60,000 plus any carry forward you've got. You have to have been a member of a pension scheme in the earlier years if you're going to use carry forward. So if you're a digital entrepreneur who's on the foundation stage and you have never had a pension, it can be seriously worth putting 10 quid or 20 quid or whatever into a very low cost pension, because then at least you're saying I was a member of a pension scheme and you can claim carry forward going forward. So from there, let's say we've got the company, we're now in the scaling position. So you have a degree of financial clarity. we want to make sure, going back to the foundational stage, that you also then use fixed drawings where possible. So the most tax efficient way to do this, or let's put this another way, the lowest tax way to do this is to keep this within tax bands. So I'll just put the tax bands on the screen now, but very simply, the first 12,570 is the personal allowance. That's a 0% tax rate. You have up to 50,270 then as a basic rate. The then 40% rate goes up to 125,140, but bear in mind there is a tax trap, and the tax trap revolves around £100,000. If you earn over £100,000, though the tax band is officially 40%, what they then do is they then go, well, actually, we're going to, every £2 to be technically correct, you earn over £100,000, we're going to take £1 off your personal allowance. So remember that tax-free allowance at the bottom? That starts to go. What that means is over 100,000, it's actually a 60% tax trap, because you get more at 40%, but you also lose your 12,570, and it broadly works out at 60% tax trap. So what's the lesson here? If you can try and keep within the bands, so let's say it is, you only need a gross amount, including salary and dividends, of 50,270. Great, that's really tax efficient. But the conversations I've been having with some of my entrepreneurs recently, we need to also then think about what is the growth trajectory of the business. And this is only really going to be relevant for people who are growing at a hell of a rate. But, so you might have noticed just a bit of a break. I'm going to break the fourth wall. Tesco shop had arrived. So I'm going to crack on back where I left off. So let's say you're scaling at a massive rate. So there's a load of money coming in. Because you're a digital entrepreneur, your costs aren't necessarily rising with it. You don't want to go down the next stage in business where you start to hire people. You're a bit worried about that kind of trap as far as being an entrepreneur. What the hell do you do with the cash? Because at the moment it's with your bank account and it's earning like next to nothing. Well, there are a couple of options that are available to you. And this is actually a conversation I was having only this week. The first is, I think we need to give any of the cash a purpose. So if it's for reinvestment, great. If it's for your own sake at a later point, great. But when is that time horizon? Because your options are, there are cash management providers out there that you can utilize. Because of regulation, it's a bit tricky for me to kind of throw around the names, because it starts getting into it suggests product advice, which can be a bit of a challenging thing from regulation. But how these cash management providers work is that, let's say you want to hold the money in cash. They effectively use technology to then spread it across different banks, which can offer you the best rate and also reduce risk, because it can spread it across various banks and keep under the FSCS limit, which has gone up to. So that's one very simple way that you can increase the interest rate you're getting on cash, even if it's appropriate for that to be short-term money, which I typically define as anywhere in the first to 1 to 3 year period. But if you can, if you've got £600,000 on the bank, the balance sheet, and then you're wanting to, increase the interest rate by 2-3%, you can see it's a substantial amount of money. It's £12,000 or £18,000 basically that you can make purely by allocating your cash in the right way through the right provider. Now then, what do we do with the rest? Because as I mentioned, if you start taking more money in your personal name, you might get hit by that £100,000 tax trap, which is not the end of the world, but it's certainly not tax efficient. And a lot of this depends on your personal circumstances. So going back to purpose, what do you need? What's the lifestyle you need to build? Have you got a spouse or civil partner that you can employ and share duties? Because then you can sometimes, subject to it being appropriate for the business, split salaries, which means you both have your own bands, and that can be incredibly tax efficient. That is a standard bit of tax planning that you should be aware of. Again, you'll have to speak with your accountant on that to make sure that they're happy with you doing that, because you can't just have someone as part of the business if they're not doing anything. But let's say that you're not married. Then what do you do? Because you're in a position where you're trapped by the 60% tax trap. However, if you start drawing more out, getting more in your personal name, it's great because it's outside of the business, if the business was to go under at a later point. But it's tax inefficient. You might be paying corporation tax at 25%, and then even the high rate of dividend tax. So you can see these rates are getting pretty painful when you add those two things together. So what do you do? Well, I think then it comes down to a conversation about how do we want to use your business going forward. So you absolutely should be maximizing the amount you can draw in a reasonably tax efficient way. If you can keep yourself to £100,000 and you're only drawing 60,000 and the business is going great guns, should you actually be looking to draw 100,000 now anyway, so that you can declare it as a dividend and so that you can ultimately get it at a lower rate than you might be able to later. But the way I want you to think about your business as far as long-term strategy is, do you see it as a cash machine? Do you see it as a pot of money? Or do you see it as a family fortress? And there is a specific reason why I'm using those phrases, and it comes down to what happens from the scaling to the freedom stage and some of the options around the company. Now, let's talk about the cash machine first. So all of this is within the company. And what's the pros and cons of keeping it within the company? Well, corporation taxes, which are the corporation tax increases depending on your profit threshold, but the highest rate at the time of recording is 25%. That is much lower than the higher rate of income tax, which is 45%, or the dividend tax. So having money within the company is still more tax efficient than it can often be at drawing out at a much higher rate of income tax. Where I come with the cash machine example is that, let's say you paid corporation tax and then these are retained earnings. They're effectively money that you have got but not actually paid it out. Well, there is no reason why the company can't then, going forward, be utilized and just extract dividends at a later point as you start to use it as one of your financial freedom vehicles. So let's say a pension is highly tax efficient for your retirement or for later life. Your business can ultimately have this money in the company and you can draw it out year on year using your band at a later point, should you decide to. And because of that, you could always decide to invest within the company. So you could go, well, actually, I want to use my company as a cash machine for the future. So because of that, I want to invest within the company because I know that there is 300,000, 400,000, 500,000 that I want to use in the future, that I want to get growth on. So the company can be used as an investment vehicle. Now, the reason why you have to be a bit careful and definitely get advice around this is it can have knock-on impacts for business asset disposal relief, and the company structuring can be worth considering depending on how big the numbers are. So let's say you've just got a very simple business and it's all in a single limited company. It is just your trading company and everything goes through that. Now, as one of the things that can be quite common for especially property investors is that they will then migrate to using what's called a HoldCo structure. This sounds complicated, bear with me. A HoldCo structure is basically where you have the parent company and then you have various different branches, is the best way to think about it, which can be used for different projects. Now, this can be tax efficient because basically the dividends can pass through. Once the corporation tax is paid, you can pay profits up and down as you see fit, subject to speaking with your accountant, getting advice, because there's some nuance here. But the key benefit with doing that is often it can provide a bit of corporate protection. So the reason why this is most common for people who have property empires is they might use what's called an SPV, which is a special purpose vehicle, for a property venture. Because what they don't want to do is they don't want to have 10 million in the company and then they set up this, they buy this property, they look to renovate it, something happens and they get sued or that it falls through. And now that liability is on their £10 million kind of their main asset. So the benefit of having these different structures is that it can separate some of the liability so that ultimately you have certain bits within the HoldCo structure which are allocated for certain purposes. It can give that additional level of corporation protection. The profits can then move from the trading company, so basically the the core business, generally tax-free, via group dividends. You can then choose when and how to take the money personally. There is a degree of asset protection because it keeps investment property or cash reserves separate from the trading business, as I mentioned. That's what the SPV. It can build a bit of a war chest, so you can accumulate the wealth in the HoldCo without necessarily triggering personal tax liability when you take it out. So if you don't need the money in its future wealth, that can be really effective. And it also can help for future sale practices. So, for example, let's say you're planning and you can sell the trading company while keeping the accumulated investments in the HoldCo. And it can work really well if there are multiple ventures as part of this little empire. There are, however, some areas you have to tread very carefully on. And I think I'm going to do an episode where I dive deep into that. So this is not that episode. This is the episode where I give you a high-level overview. The main one is around business asset disposal relief. So if you don't know, business asset disposal relief is formerly entrepreneurs relief. And it reduces the capital gains tax liability when you sell businesses or shares. Now, this is going to increase. So the changes are, and I'll just check my notes, currently from 2025 to 2026, business asset disposal relief changes are now 14%. From 2026, where most people, let's be honest, are going to benefit from them, the changes are now 18%. So if you sell your business and it's eligible for business asset disposal relief, formerly entrepreneurs relief, that means that the gain is likely going to be taxable at 18% for anything qualifying within that amount. Now, the high rate for capital gains tax is 24%. So it used to be 10%, this relief. So actually you can see there would have been, if the high rate for capital gains tax is 24% versus 10%, that's a good 14% advantage. The difference now is kind of getting less and less. It's 18% versus 24%. The benefit of business asset disposal relief isn't massive. The other thing I want to just mention on business asset disposal relief is there was a massive change that came in at the end of last year, a bit underreported, and a lot of people don't even know about it. And I just want to talk it through because it actually, I think, is going to have a massive impact on kind of mid to higher level digital entrepreneurs. You may have heard a lot in the press about farmers rioting on Westminster. Protesting. Definitely don't want to say rioting. As far as I'm aware, they didn't riot. Protesting on Westminster. Because when you have the business asset disposal relief is also wrapped up with agricultural relief. And they are a combination. So when you have these lifetime limits under current legislation, it's both business relief plus agricultural relief. And it's combined. Now, that's going to be relevant in a second, but agricultural relief was the one that hit headlines, and it's because farming is one of the lowest paid jobs in the country. But these people can have a lot in relation to land value because land itself is very expensive. Now, originally, the aim was that the lifetime limit was going to be for agricultural relief under the previous budget was going to be £1 million. Now, that isn't very much if we're thinking about fields and tractors, and, I'm no expert in this, but it wasn't very much, is the truth. Now, going forward, there has been an announcement that has now been increased. So this applies for business relief and agricultural relief. And the reason why, didn't really make that clear. The reason why that's such an issue for farmers is anything above that is then chargeable at 40% inheritance tax. See, the most important thing I didn't mention, I'm good like that with content. So what farmers were protesting about is that they were like, well, we are going to get absolutely hammered and have to sell our farms, our family farms, because we've got a couple of tractors and a couple of acres of land, and we're in 2 million and above on the value of our farm. So the government eventually clearly bowed to some political pressure. And there are two big changes around this to be aware of. Firstly, there is now a £2.5 million allowance, which is for combined of business property and agriculture relief. So you can't have business property and a farm and double it up. It's both. There is then anything above that, you do still get relief, but it's at a low rate of 50%. So basically, if inheritance tax is 40%, it'll be 20% relief. But you can combine that with your spouse. And this is big. So for digital entrepreneurs, it means that if you are married and in business with your spouse and subject to a whole ton of areas I can't dive into in relation to company ownership, you now can combine those two bands. So could potentially have a £5 million business. And then in addition to that, have your nil rate bands of £325,000 per person. And maybe you wouldn't have your main residence nil rate band because that would get tapered. So I'll forget that. But basically means that up to £5,650,000 could potentially be kept between an entrepreneurial family if 5 million of that is the business, and £650,000 is the residual estate. So that's a massive change from 1 million. So I kind of feel like I've gone off track with that one, but it's important to understand business asset disposal relief. And the reason why that's important is coming back to my pot of money example. If you are someone who is planning to sell your digital business, and I'm not sure how relevant this is for a lot of creators and digital entrepreneurs because they're so much key person risk that they are often the business. But it can be worth wondering or planning if you are planning to sell the business and realize that sale, and whether business asset disposal relief has a big impact. Because holding a large amount of cash on the balance sheet and also investing can compromise your ability to claim business asset disposal relief or entrepreneurs relief. So it's important that you seek advice and understand the long-term strategy if you are aiming to sell utilizing that. The rules are effectively, if cash is held on the balance sheet for no business purpose, it's generally treated as what's called an accepted asset. Basically, they say it's not part of the business. It has no business function. It's being effectively kept within the business. For investments, the rules are way more complicated. So I think I might dedicate a whole video on this kind of stuff. If this kind of stuff is interesting, actually send us a message, george@creativefinance.co.uk, because I would love to know whether I am just taking away the lives of my mum's cat. So the reason why that's important is ultimately if you are investing in the company and over 20% is actually to do with investing as opposed to a trading purpose like your standard business, that can impact the ability to claim business asset disposal relief. I will have to skirt around the edges of this because it's too complicated a topic to go into without diving off topic entirely. But you have the cash machine where you're going to keep the cash, and ultimately the business's sole purpose is a future wealth vehicle for you to draw down dividends as you see fit, which is completely fine and legitimate. You've got the pot of money where it is ultimately then decided to be sold at a certain point. So you need to be tactical on business asset disposal relief, or you should certainly consider if that is a part of the strategy. And then you have the third leg, which is the family fortress. And this is where the business is actually being used not only for yourself, but as an intergenerational planning vehicle. And this is really where we start going from scaling, going back to my wealth ladder, from freedom and legacy. So freedom perhaps was the HoldCo structure and using the business as a cash machine. Legacy is now looking at family investment companies. And what is a family investment company? As the name suggests, it is just a company that primarily works for investments, primarily operates as investments for the purposes of a close company for a family. Why do people utilize these? The key rationale comes back to the structure, the position that in today's current environment, trusts can still be incredibly powerful, but post 2006, I'll get it right, we entered what's called the relevant property regime for trusts, which means that there are now potential entry charges on trusts, there are potential exit charges, depending on, and again, maybe this is a thing for another video, they are not as tax efficient as they once were. And what a family investment company can do is it can basically keep any potential gains at a corporation tax rate, which can be lower than the trust rate and lower than an individual who's earning a lot of money. But also within a family investment company, effectively as part of the Articles of Association, which that's kind of like the blueprint or the DNA of the company when you set it up, you can have different share classes. So you can have like A and B shares. Alphabet shares is the most common phrase when used with this. Now, they can have different requirements at different points, and you can actually even have trusts within family investment companies. And the aim of a family investment company is often over time, subject to board control, you will move assets into the junior members of the family over time. So this isn't something that I would typically ever suggest someone gets involved in unless we're looking at the wealth point from 3 to 5 million plus. You are going to be committing to a lifetime of paying solicitors, advisors, accountants. But the reason it can be so powerful is because it can give control, but also over time at a lower tax rate. So family investment companies can be very powerful to still provide some income, but ultimately transition the wealth that you have in the company to the family over time. Now, you do need a substantial, pretty chunky amount of money for this to be worthwhile. And ultimately, there are no perfect solutions. There are only kind of a mixture of compromises that can be right for individual circumstances. So I'm not suggesting this is right for everyone. Many people may not even need a HoldCo structure. They may just have let's say you are just a pure lifestyle creator. You might be in a position where you go, actually, I'm just going to have my limited, I'm going to fund my pension, I'm going to fund my ISAs as we go, I'm going to try and keep my tax bands as tax efficient as I possibly can get. And then going forward, what I'm going to do is I'm going to have these reserves built up in the company and just effectively declare dividends until my pensions kick in and keep the business going for as long as I can. That is a completely legitimate strategy. Of course, within that, though, what we want to avoid is having huge reserves building up, which are just going nowhere, especially because business accounts pay very little on interest. So you need a thoughtful plan. So that is a very high level, really high level wealth blueprint. And I just want to recap what I've talked about there. We've talked about the importance of, when you're financial planning, purpose first. What is the life we're building? A plan, how we're going to get there as soon as we can, as tax efficiently as we can. Products. There's a lot of detail I've not touched upon. I feel like I've said that too many times in this episode, but there is, in relation to different structures. I've not talked about the more complicated stuff, like you can buy commercial properties within pensions, or you can lend off assets and all that fun stuff. But ultimately, the challenge is the partnership bits, which is how are you actually going to implement this strategically and with discipline over time? That's kind of, if I'm being honest, how I feel like I earn my money. We've got the core of the digital entrepreneur wealth ladder: foundation, growth, scaling, freedom, legacy. Foundation is habit, automation, getting your house in order. Growth is now about being more intentional with structuring and making sure that you've got your financial fortress and potentially your barbell strategy for growth. Scaling is where things get a little bit dicey, but that's hopefully as you're starting to become more and more successful. You're starting to bring in some really good money. You're starting to outsource your time. Now at this point with my clients, I would want to be really locked in on our automations, really starting to hit those goals in their financial plan. And then we're getting to freedom. That's where we might consider things like a HoldCo Structures. We might consider things like how we're utilizing money and effectively when is money being used at a certain point. And then if you get to the next rung of the ladder, which not everyone needs to or perhaps wants to, that's where you start thinking, okay, maybe I might have enough in my own position. How do I start considering legacy transfer? How do I make sure that this business survives me? Within those decisions, it's often worth thinking about how you, at this stage, consider your business as a cash machine, a pot of money to be sold, or a family fortress. These are not one and done decisions. You can flip this in the future and change it, but the only thing we need to be mindful of is if you're holding a huge amount of cash on the balance sheet and then you're planning to go from cash machine to pot of money, for the reasons I talked about, you may have issues with things like business asset disposal relief. So you need to work closely with your financial planner and your accountant to make sure that you have that purpose. So that was the Creative Finance Digital Entrepreneur Wealth Blueprint. I hope that was useful. I've tried to up the energy so that I am less like Eeyore on Xanax. But let's move on to the next topic, which is wealth wisdom. And I'm going to have a sip of my tea. Michelle can cut this. Okay, wealth wisdom. I want you to think about what is your theory of wealth. So I have dealt so many times with people who spend their life on a path that many people would consider success, only to get there and feel it's hollow. They spend years being the person at their firm, only then to retire and go to the golf course and it be terrible for their health, but also just clearly them not be happy, because they go from one day from being the person that can get a whole team to jump on command, and then the day after they can't get a plumber to turn up. And it's a real challenge for identity shift. I have also seen people sacrifice health, years of their life, relationships with their kids, only to chase an arbitrary number for the sake of impressing someone without a name or a face that's probably in the back of their mind, something to do with their childhood. And it seems it's such a waste, if I'm being honest. Like, what was the point of doing all that? Life isn't a rehearsal. You only get one shot. So I think the thing that, my view is millennials and the later generations, Gen Z or whatever, or Gen Alpha, which my son's a part of, I think they've cottoned on. I think that they are now much more intentional about not just following the well-trodden path of get a corporate job, retire at 60, and they should do, because all of the things that came part and parcel with that are frankly not available for the majority. People do not have a single steady job that lasts them for 30 years and they get the gold watch. People do not have kids before they turn 30, buy a house, and can have the ability to do all those things. That deal is basically no longer on the table for the vast majority of people. So it's only right to reflect on that. There's also been things like social media, which, let's be honest, it amplifies the top 1-2% and pretends everyone's living that life. So people have this comparison, which I don't think is a good thing, but it has made people reassess. And I think the reassessment in itself is good. So what do I mean when I say a theory of wealth? So many people, when I talk about wealth, they think just money. And wealth and money is a part of wealth. It's like your health. You can't ignore it. If you ignore it, it will choose your life path for you. But it's only one kind of area. And what I'm about to say is not me saying this should be yours. I'm saying you should have one that you are thinking intentionally about. So for me, this is mine, and this is what I often think about when I'm making decisions as far as compromises. Because in an ideal world, we'd all have it all. We'd all, be millionaires, have six packs, have an amazing family. But it's just not realistic. We have to compromise in seasons of our life. I do like the phrase, you can have it all, but not all at once. And because of that, it's important, I think, to have not something that I tell you, but something that you have as far as this is what a good life looks like to me. I may not be living that life right now because my business is taking off and I need to commit to that. But these are the areas that are important. So for me, wealth, I think, has 5 key elements. It's got money is key. You cannot, and I'll say it first because it's the most obvious, you cannot avoid money. It is a fundamental fact of a capitalist society, which is the society we live in. So money is something that, if I'm being honest, probably takes way more of my mind than it should. But it's fundamental because it can buy you freedom. And it can buy you other experience. It can buy you other areas that are so key to what being wealthy truly is. So that's one of the first areas. The next is relationships. The Harvard Grant study, which is the longest study on happiness and well-being and longevity, found that ultimately relationships are the single biggest determinant of long-term happiness and longevity. I believe you can actually have 2 packs of cigarettes a day and it not be as bad for your health as being lonely. So if you're somebody who maybe is on the entrepreneurial journey and you are completely over a multi-decade period neglecting your relationships, that is going to come home to roost at a certain point. Or certainly that's the way I think about it. So you should be doing what you can, whether it be family, friends, to maintain and to commit, like you would your health, to maintaining relationships, because they are key and it is in your best interest to do that. So that's number 2 of the 5 points. And this is just me, remember. Number 3 is health. The phrase is, what's a healthy man wants a million things, a sick man only one. It is so true. Your health is the most important thing in relation to how you experience every single day. And you do need to commit to maintaining good health to remain or to be seen as wealthy, in my view. The next one is time. So Warren Buffett is one of the wealthiest men in the world, multi-billionaire. He is also 93, I think. He might be 94 now. Don't quote me on that. But the truth is, statistically, he's more likely to die next year than he is to live. And would you swap places with him? Of course you wouldn't. So even though he is a multi-billionaire, he is considered probably the greatest investor of all time. Certainly, he's known as he's the most popular of all time. So he has really achieved professionally, but he has frankly not got much time left. And that, I think, tells a really key story, which is that it's all well and good having all the money in the world, but if you don't have the time to enjoy it, that's crucial. A book behind me, actually, no, I think my son's taken it to the other room. It's called Die with Zero. It's a really interesting book by a guy called Bill Perkins. I think it's actually quite essential reading for entrepreneurs, even though many entrepreneurs probably don't need to read it because that's why they're entrepreneurs. But they talk about the utility of money over time. £100, £100, £1,000 when you're 25 is very different from when you're 65. So when we're making these big trade-offs, something I think about a lot is you cannot go back when you're 65 and have your son when he was 0 to 3. You can have money at that point. You can maybe have time, but you cannot buy that time in that point in your life. So when you're making these key decisions around what a rich life, sound like Rami said it, looks like to you, you should be thinking about what areas you're willing to compromise on. I don't want to paint this picture that your theory of wealth is going to be perfect. Mine certainly isn't. This is a phase of my life where I am thankful I'm spending a lot of time in relationships. I'm able to spend a decent amount of time with my son, considering how much work I'm doing. But there are other things that I'm having to give. I'm not able to see my friends as much. I'm working all the time. My health is, I'm not able to go to the gym and stuff as much as I would normally. There's all these other things that are kicking in because this is a season of life. This is not saying that everything has to be ordered perfectly in 25% or 20% percentages at all times. And if it's not even, it's not right. It's about saying this is the North Star that I'm heading towards, and this is how we're going to inform the decisions. And how this could work is let's say you are deciding to increase your business, your digital business, and you're going, right, we're going to hire 5 people. The next year or 2 is going to be hell. And there are going to be some things, as far as my theory of wealth, that are going to take a hit. That's fine, as long as you're intentional about it. Because what we need to do is we need to understand that you're making these sacrifices for a purpose, because this is a season, not that we've abandoned your theory of wealth. Because if you abandon your theory of wealth, or if things just don't feel right, it's going to cause an identity issue. And that could make you abandon potentially a project earlier than you should. So we did money, health, relationships, time. The final one is purpose. I think this is underplayed, and I deal primarily with retirees. And this is something that I see and I'm often having conversations with. You need as much... The ideal is you have enough purpose to get out of bed in the morning and enough money so that you can sleep at night. That's kind of the phrase. And purpose is underplayed. But going back to the literature and the data, purpose and meaning are one of the key things that are going to keep you active, keep you engaged. It's much more, ethereal. It's much more hard to define what is purpose. But you do need something to push you to get you out of bed in the morning. And for me, they're the kind of the 5 elements that I always try and keep in mind. So what I want you to think about is when you're planning your finances and you're planning your future, what does a good life look like? It doesn't have to have the 5 points that mine does. It can be completely different. But this is what I would typically do with clients when we're talking it through, because we have to, if we're going to make sacrifices today, we have to work with the end in mind. What is the life that you are planning to achieve? I hope that was useful. I know that was a little bit less structured than normal. I'm going to be diving deep into quite a lot of the topics and the structures of various financial planning and wealth building strategies going forward. If you enjoyed that, send us an email, george@creativefinance.co.uk, or sign up to the Creator Wealth Blueprint below. Thank you so much for listening. See you next time.